I'm Sebastian St. James. In a previous video, one of my viewers asked, Sebastian, firstly, love your channel and love you, man. Thank you, Ash. It's always a pleasure getting a comment from Ash. I get paid on the 20th. I've got 10k to invest. Where would you put it for the best growth in this year? What would the return potentially be and why would you choose it? I know you're not a crystal ball, but from all I've seen and heard from you, you know a hell of a lot more than me, bro, and knowledge is power. Yes, I did quote a Mortal Kombat video game just there. Right. What a series of very interesting questions. Let's summarize them. Firstly, I get paid on the 20th. I've got 10k to invest. Where would you put it? And more specifically, where would you put it for the best growth this year? I've kind of broken up those questions. He did specifically ask this year, but I thought I'd generalize it a bit because not everybody is investing just for the next 12 months. So I'll answer both. What would be the potential return? Why would you choose that investment? And Mortal Kombat rules. The Mortal Kombat theme song is copyrighted, but I thought that was a pretty good substitute. I get paid on the 20th. As this question is actually 2 months old, it appears that I missed your deadline. So I'm sorry about that. At the moment, I've got 46 questions in my queue, and I'll get a video made on each and every one of those questions as soon as you rise up to the top of the queue. So hang in there. All right, how can I make this simpler so that if you've got a question in the queue already, or if you're about to ask a question today, you can get your answer much more quickly? What's the easiest and fairest way about doing that? Okay, if you want your question bumped to the top of the queue today, then there's a super thanks button. If you donate, let's say something quite small, $5, then I will bump your question to the top of the queue and you'll get your question answered next. This is only available for the next 3 days. When I release my next video in 3 days' time, that's it. It's over. And there we go. You can now have your question answered immediately if that's important to you. $10,000 to invest. If you've got 10k to invest, where can you invest it? Well, can you invest it in direct shares? Yes, no problems. There's a good amount. In ETFs? Yes, for sure. In bonds? Yes, certainly possible. Physical property? No. 10k wouldn't go far on an actual house. I mean, you can put it down as a down deposit, save up for a house, no problems at all. But if that's all you've got, 10k, I'm not about to get any more, then no. Physical property is out of the question. REITs, on the other hand, real estate investment trusts, yes, you can certainly put it there. REITs are property, but they tend to be commercial office blocks, warehouses, things like that. But yeah, they're definitely property and definitely rent. So where would I put 10k? Firstly, it depends on the time frame. Are we talking about 1 year, which Ash is? 2 years, 5 years plus, just depends. Let's look at some time frames. 1 year, high interest savings account. Look, it depends. If you've got exactly a year, like I've got a bill to pay, for example, then you need all that money at the end of the year. You don't need market risk. On the other hand, if this 1 year is just one of many years, and it's like, well, where would I put it this year? But I'm going to take that money and then I'm going to invest it somewhere else afterwards. Well, this opens up your options, doesn't it? So, high interest savings account is about your best bet if you've got to take it out after 1 year exactly. 2 to 5 years, I would avoid term deposits right now. Traditionally, within that period, you could go to your bank and put in a term deposit, but at the moment, interest rates are rising. So if you lock in your money, then in 6 months' time or 3 months' time or next month, let's face it, when the Reserve Bank governor decides that he's going to put up interest rates, whatever you locked in, that interest rate will now be out of date. So this is not a good time to be locking in your money into fixed returns. Share market's fine, fixed returns, no. So a high interest savings account would be a better choice within that period. You could also do direct bonds on the ASX. The reason why I'm suggesting direct bonds is because they actually pay out a coupon, right? Because that's how bonds work. If you own a direct bond through to maturity, then it doesn't really matter so much what the price fluctuation is, but you'll get paid the coupon out over time. However, you don't want to overpay for that coupon, which you certainly could risk doing with direct bonds. Here are the government bonds that are on the market at the moment. You can see their codes, their coupon rate, and when they expire. The problem with bonds on the Australian market is they're very rare, very hard to come by. So investing in direct bonds in theory can be a great idea. In practice, they can be very hard to get the bond you actually want and not overpay. So you think to yourself, well, I'll just go into a bond ETF. Well, that's an interesting thought. You may not be rewarded for that thought, however. Here is a bond fund. It is the BetaShares Australian Government Bond ETFs. So in theory, they're just holding a whole lot of government bonds. How have they done? Well, look at the graph. Over this year, it's down, 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 down. But aren't interest rates going up? Yes, they are. Is that reflected in the graph? Well, no. If we look from June onwards, it's sort of flattened out. Is it going up? No, it's definitely not. Surely bonds are actually paying out coupons, so total return, it should be good, right? No, it should be, but it isn't. The actual returns for the Australian Government Bond Fund, the one I gave you before, over the 1 month total return, minus 4%. 6 months, minus 10%. A year, minus 16%. 3 years, minus 5%. If you held this bond fund from the day it was created, you'd get minus 3.85%, including coupons. Bonds are safe? No. Apparently not. Factor that in. If you have a time frame of 5 or more years, then direct shares can be a great option. Or ETFs, that's another good option. So, do I need that $10,000 guaranteed for some future bill? There's no guaranteed way of investing your money except stick it in cash and leave it in the bank in a high interest savings account. You don't know what the interest rate will be. You've got no guarantee about that, but at least you won't go negative. Relative to inflation, yes, you might. You might go backwards. But if you've got $10,000 exactly and you've got a bill coming up which is $10,000, then I would not be sticking that in any market at all because you've got no guarantee that your $10,000 won't come back as $9,000 or $8,000 or $7,000 while you're trying to get $11,000, $12,000 or $13,000 out of it. So, short term, if you absolutely need that exact amount of money, yeah, leave it in cash. I can tolerate risk. Well, easy. Direct shares or ETFs. I'm about to give you a great comparison between leaving your money in the bank versus putting it in shares. This will clear up a lot of things for a lot of people. This is built by iShares. It's their Core Cash ETF. What is their objective? Well, we'll read about that in a moment, but this is basically the version of putting your money in the bank if you're investing in the ASX. Management fee is 0.07%. Why bill? Achieve capital preservation and regular current income with a diversified portfolio of high-quality, short-term money market instruments. Right, so kind of like your bank equivalent. Let's see how it actually performs over time. Here is a graph. The line in the middle, that black line that you can hardly see that goes absolutely nowhere, is BIL. This graph is over 5 years. BIL literally flatlines the entire time. That's cash in the bank, particularly during low interest rates. The multicolored line, which is going up and down, zigzagging across BIL, well, that's this ASX 200. What will we notice in this graph? Well, this is 5 years. Over the first year or two, it's sort of going up and down through the bill line. In March, there's a major crash. Now, that doesn't happen too often, but you can see you're well above and then you crashed through it. But notice what's happened since March. It's climbed up and up and up again. And in fact, it's returned over the 5-year period of time. This is the ASX 200, 9.043%. Bill has returned nothing. Remember, it's basically flatlined. That is a brilliant representation of cash versus a share market. Sure, in the short term, your share market will go up and down, and it may even go down below your cash rate, but give it a few years and you can see it definitely has return and it definitely outpaces money in the bank. So the choice is yours. If you're investing for over a period of 5 or more years, do you really want it to stick your money in the bank or do you want it to grow? Well, grow, hopefully, but the choice is yours and based on your risk profile. Where would you put $10,000 for the best growth this year? The first place you should look at is index ETFs. This is IVV. This is the S&P 500 ETF. Over 10 years, you notice it just goes up, up, up. Positive expectation. Certainly got some down periods, but yeah, it sort of recovers, no problems at all. Have a look at the more recent year. Yeah, it's been a bit turbulent, but then zoom back and have a look at that graph over 10 years. Do you expect that we will recover from this tumultuous period that we're going through? Yes, because the S&P 500 has a positive expectation over time. Other than ETFs, where would I put my money? Well, I'm kind of personalizing a little bit now and saying, based on what I'm liking in the market at the moment, there are a few places I'm interested in. Battery metals, such as lithium, nickel, cobalt, they're certainly in hot demand. The world is going crazy with electric cars at the moment. Electric batteries require lithium, cobalt, and nickel. So, what do you think is going to be in hot demand going forward in this transition from fossil fuel cars over to electric cars? Well, the metals required for electric batteries for electric cars are somewhat rare, or more to the point, they're located in geographically difficult places where it may be the government's choice to say, no, you can't have our precious metals for your batteries. So, due to the pressure of electric vehicles coming onto the market, my expectation is that the mining of these metals, the commodities themselves, should outperform the market over the next little while. Mining in general, so commodity prices are pretty high, and Australia is the mine of the world. Australia has done really well with their mining over the last few years. I do expect that to continue. Now, you can always have some ups and downs over the short term, but over a longer period of time, yes, I do think mining should outperform some other sectors. And energy. There's been a worldwide shortage of gas. We know that Russia is closing off pipelines. All over the world, we're having difficulties getting energy. So shortage means opportunity. And so yes, anything within energy, I would expect there to be an outperformance in that area. Also renewables. If you're having difficulty actually getting your gas in the first place, then of course you look towards solar, you look towards wind, you look towards all forms of renewables. And that is going to be a booming sector going forward. I'd expect that to outperform as well over the long term. Tech should outperform over the long term. Why? Tech is great because it has low capital costs. If I need to buy a train, that's very, very expensive. If I need to spin up a service for you, then, it costs me next to nothing. Once I have the infrastructure, well, that costs. But from then on in, everything sort of spins up by itself and costs me next to nothing. But I can charge you a fortune for it. So tech is highly scalable. Due to the scalability of it, over the long term, I do expect it to outperform the market in general. So should you rush out and buy into the sectors which I listed there? Well, it's totally up to you. You do you. You've got to do your own research and figure out what is right for you personally. What would be the potential return? The average return of the S&P 500 is 10.5%, and I've done a video explaining all of that. The math is all in there for you. I'd expect commodities with the supply shortages to outperform that. I'd expect tech to outperform the S&P over the longer period of time. In fact, I know it will, because I've got a video which demonstrates that. Here is Nasdaq versus the S&P 500, and we discover from that video that it actually outperforms. But all the data is in that video, so you can watch that for yourself. That's a reasonable expectation of returns over the longer period of time. Ash is not asking that though. He's asking what is the return this year. The problem with that is you don't really know. The economy at the moment is going through some big issues. It's likely to go into recession, so that's not going to be a good return. But the share market is down now. Once we get out of the recession, then it's likely to skyrocket. Can't guarantee that, but it would make sense that it returns to normal over a period of time. 1 year is far, far too short to make any predictions, particularly through a rough period which we're going through right now. Well, if we don't know what the economy is going to do right now, the Reserve Bank governor doesn't even know what the economy is going to be doing over the next few months. How do you proceed? Well, it's all based on probability. What has the likelihood of performing the best over a period of time? You invest in those things, and then what happens now over the next 6 months, over the next year, doesn't matter because you have a positive expectation over time. That's always what you should think as an investor. So when investing, answer this question. If I invested today and fell asleep for 10 years, what would I feel comfortable investing in for that period? In this video, I said the long-term average of the S&P 500 is 10.5%. Other people say 7%. Where do they get that figure from? Why is yours so high and theirs is so low? Well, you have to ask them. I don't know. But I've actually done a video which explains that. It lists all that out in great detail with all the proof. You should watch that right now. Go ahead and see the proof for yourself.